Welcome in, folks. It's the rare buy one, get two free in this one here today. Just a stock market in general focused reaction video here today in this one, okay? First one's from 3 hours ago. We just now started to see flows back into the stock market. I want to react to that one, give my opinions, perspectives there. Then I want to react to this one. The markets are in a highly transitional period here. I want to react to that one, give my opinion. And the last one, the markets are trending up and you continue to trade this thing along. I want to hear what this gentleman has to say in regards to this one. So appreciate everybody joining me as always. Thank you for being subscribed, folks. A new all-time high subscribers in the history of the channel. We're going to be 30,000 plus subscribers deep by likely this weekend. So I appreciate every single person for being here as always. And also just so you guys know, the Patreon tier where you get to see the moves I'm making in the market, the $10 Patreon tier, we've had that closed for months. We opened up for July 4th. That closes back down at 8 p.m. exactly tonight, 8 p.m. So if you don't get in by 8 p.m., too bad, so sad, okay? So if you want to access that, pin comment down there. It's $10. It's a no-brainer. You can see the moves I'm making. You get to see exactly how I'm building up a portfolio through Fidelity Investments. So yeah, that's pin comment down there. Alrighty, guys, let's get into this.
We've seen an aggressive rate hiking cycle. We have recession concerns. We have a lot of things going on that are pretty much unprecedented, not even to mention the economy coming out of the recession, the pandemic still. Are there something in the technicals that we have here that can cut through all that noise and disruption and give us a clear picture for the second half of the year?
Well, I think the thing to keep in mind is just so much negativity has been priced into stocks. And, really things turned around when we got to late last year on September, October, when it became evident we weren't moving into a stagflationary crisis or a major recession. And since then, we've seen a steady upturn in earnings revisions as it's become clear that too much negativity had been priced in as far as the outlook for earnings. And so I think what we're seeing is what often happens. The markets climb a wall of worry, and we're still at that point where we just now started to see flows coming back into the stock market. And we haven't had flows. In fact, we've had net outflows all year, even though the market's been working its way higher this year.
Yeah,
so what does that mean, essentially, when he says, we've been seeing outflows all year, even as the market went higher, right, and stocks went higher? Basically, what that should tell you right there, and it's very important, then basically tells you that there was no belief in the rally, that it was lasting. It was just a bear market rally. That's how a lot of folks felt. And so they hey, I made some money, I'm cashing, I'm moving on, okay? And so it's important to understand that's not a very normalized market. Like usually people are going to let things kind of ride out and, kind of focus on the long term. You're going to see more inflows. But when people are not convinced, right, and when they think, oh, it's just a bear market rally, they're going to continue to outflow money. So I think that is an important subject.
You're just citing some Bank of America data about inflows in the stocks and ETFs. But I do have to ask you, I want to be very pointed about this. What technicals are you seeing that are giving you second half confidence? Because it feels like there's a lot of mixed signals.
Well, you can just start with something very simple, which is the 50-day moving average on the S&P 500, which has crossed above its 200-day moving average, and both of those are rising. That's something we saw back in 2020. In fact, we have a number of technical indicators that have given us signals that we hadn't seen since the second half of 2020, which was the beginning of really the run-up we had until the end of 2021. So, I think broad-based our indicators, we have a global balanced account model that's now reached its highest level in terms of equity allocation in...
Personally, I don't care about any of these 200-day moving averages and 50-day moving averages and all that stuff, okay? But I can tell you there's a lot of people on Wall Street that give that a lot of, let's call it, importance, okay? And so you just got to always understand what all these other folks are looking at and what they think is valuable. And they're like, oh, this is above the 200-day, this is above the 50-day. You're going to hear that a lot out there from a lot of these more technical folks on Wall Street. And ultimately, they make a lot of their trading and investing decisions based upon things like this, okay? And so, you just got to understand that's part of the market.
Several years.
Okay.
And so we're just getting more and more confirmation that this is a sustainable uptrend and not a temporary move higher.
Yeah, speaking of an uptrend, I just want to point out to the viewers, right now we're looking at the 50-day and the 200-day charts when it comes to the NASDAQ and S&P, and we're seeing the line there showing the 50-day is moving above the 200-day. For the viewers, the white line is the 50-day. So we talked about inflows into stocks. I know you're also looking at inflows into stocks and bonds. What signals are you seeing there that are giving you confidence in the second half?
Well, it's the fact that the flows are going. I mean, usually when you have, even if bonds are holding their own, stocks are going to outperform bonds on the upside. And we're seeing that trend start to turn since we've had those outflows, and now we're seeing more flows into stocks relative to bonds. And what's happening now is you've got sort of this inverted yield curve situation where you don't want to, you want to shorten duration. So bonds are, really challenged now because the whole case for bonds had been we're moving into a much worse economic environment, and that's becoming less and less evident. So that's going to be a headwind for bonds at this point. Bond yields have been in a trading range now for, several months.
All right, so historical averages have the S&P rising about 4% in the second half of the year after it increased 14% in the first half. That will put us at about 4670 or so. We haven't seen those levels since January of 2022. Do you believe we can get there, maybe even surpass?
Yeah, I think it's likely we'll be seeing record highs this year. I wouldn't rule out weakness during that seasonal period of August, September, October. That tends to be the worst period of the year. But, on average, a cyclical bull market, and we've been calling this a secular bull market since 2009, those bull markets take the market up by 100%. And, it seems like a stretch from here, but that's what the averages are, and everything's lining up to say this uptrend's still intact. So
it does seem like a stretch. Do you have an S&P target for year end, just to give us a sense of how bullish you really are?
No, I don't personally have an S&P target. I look at things globally as well because we track the MSCI indices, and the All Country World Index is the major benchmark I look at. And the U.S. is sort of leading the way here, led by technology. The U.S. has been outperforming, and we're overweight the U.S. within a global context. So, I think we'll be likely seeing a year. Entering the year, we had a conservative estimate of 10% for the year, and I think we're already we're going to be well above that by the time the year is over.
Wow, fascinating. It's so fascinating because going into this year, everybody is just so bearish, right? And now I'm starting to hear more and more folks start to talk about market's going to be all-time highs at the end of this year, which is incredible to think. To think about where we started this year at, right? Where we were at in Q4 of 2022 and how much negativity and bearishness there was. And to now, just a short, let's call it 7, 8, 9 months later, for us to be talking about all-time highs in the market. And more people get convinced we're going to all-time highs in this market. It's extraordinary, man. And it goes to show you how fast things can shift in the market, negative or positive. And we witnessed it in back-to-back years. We witnessed how positive the market was at the end of 2021 and how negative it went so fast in 2022. And now we've seen the exact inverse of that, where the market was just insanely negative and how fast it has gone insanely positive and bullish. It's extraordinary, folks, okay? All right, next video up to react to in regards to the market here is this one. Let's get into this one.
Half outlook. So technically, gambling's consumer discretionary. Over the last month, those stocks have been the best performers. Do you see the consumer continuing to be willing to spend on just about everything, including gaming?
I think when you couch it in the context of consumer, and yes, gambling does appear to be consumer discretionary on the surface. The way we look at Las Vegas, which is one of the points Contessa made, is that it's really a convention, event, and destination market. And because of the logistics and just the large numbers of people involved, that has taken longer to recover and is still accelerating. And so we do have a bullish view on Las Vegas, and the stocks there are MGM and Caesars, because, as you point out, the Formula One is coming to Las Vegas for the first time in November, followed by the Super Bowl early next year. And with all the sports events, concerts, the Sphere opening behind the Venetian, there's just a lot going on in Las Vegas and a lot to like.
Yeah, you mentioned the Super Bowl.
Yeah, you guys know I obviously, my main house is in Vegas, right? This house is Arizona. But in terms of what I'm hearing in Vegas, from what I hear in Vegas, convention business and all the things that go around that convention business, 2023, it is back in full go, like this entire year. Everything's back, from what I've heard, okay? 2022 actually was not that year. 2022 was the first year where companies and a lot of these conventions started to do, big events again in Vegas, but it wasn't fully back. 2023 has been the year where it's fully booked up. almost all these hotel companies are fully booked up. Their calendars fully booked up for the year and into 2024 as well, from what I'm hearing. So, that is a very important, especially during the week, because the thing you got to understand about Vegas is people like to come on vacation on the weekend, right? People like to come Thursday, Friday, Saturday, leave out on Sunday. But what do you do Monday, Tuesday, Wednesday? Well, that's where a lot of that convention business comes in, because a lot of the conventions are almost always during the week. And so if you're going to make up for all the traffic you lose when people aren't there, right, because they're not coming out for the weekend, you got to make up for that somehow. And the convention business is the beautiful business that kind of makes up for that. And that's how you pack out your restaurants and your gaming floors and all that, even during the week, okay?
Before that even starts, we obviously have the NFL season, which is, generally the busiest time when it comes to gambling overall. Also, during the pandemic, we saw a rise in digital gaming. So when you put those two forces together, the NFL coming back and digital gaming, do we continue to see people spending on these digital platforms? And is that a higher margin business for these gaming operators?
To answer your last question first, no, it's not yet. But the importance of you raising the point is that digital gaming has only been legal in this country for a couple of years now and is pivoting to profitability this year, where there's been a period of investment and spending. And going into this NFL season, expectations are very, very high for both MGM and Caesars, as I mentioned, to pivot to profits in their digital business, as well as some of the other players that I think Contessa mentioned, such as DraftKings, that is expecting a big profit for the fourth quarter of this year.
Check out that year-to-date on DraftKings. Holy smokers, that ain't no joke.
And I think that's what has the street very focused on those stocks continuing to rise through the remainder of this year.
All right, we're talking a lot about Las Vegas. I also want to touch on some other things on the other side of the world, including Macau. We've seen an uneven recovery in China. We just talked about some somewhat disappointing services data. I know that doesn't relate directly to the gaming sector, but in general, we've seen a softer economy than China than many people expected. Does that extend to Macau as well?
It does, and I think at some point the macro backdrop for Macau will start to come into play, and whatever government stimulus support may or may not occur will become much more relevant. For now, we are just, and I was over in March to see Macau for the first time in a couple of years, just getting the access, just getting the airlift from mainland China, just getting people comfortable back and traveling again. And so Macau is really just starting to recover to some state of new normal. And the importance, Frank, of the new normal is that VIP junket business in Macau has largely been made illegal. And so that's gone away. And it just changes the business calculus of what's happening in Macau. But it is returning to some new normal at some higher profitability.
Yeah, so in terms of the whole Macau situation, right, and it's important if you own any, stocks like MGM, Wynn, LVS, any of those guys, right? I mean, at the end of the day, the Chinese economy is almost irrelevant to Macau just for the mere fact that Macau's been closed down for years. And so any sort of business is good news in Macau, right? It doesn't matter if there's even a recession in China or it's just a slower economic environment in China. At the end of the day, the fact that those properties are just able to be open finally and people can travel to them is the best news you could ever imagine. So Macau should ramp. Obviously, 2023 should be far better than 2022. 2024 should be far better than 2023, and so on and so forth for, probably this entire decade, to be quite honest. And if it's not, it's likely because the government did something to mess everything up, because that's what happens in China, okay? Last video for me to react to here. The markets are trending up, and you continue to trade this thing on the long side.
Second half of the year, we're in a bit of an unusual situation. The Fed pausing in a historically quick rate hiking cycle. We have some recession concerns. At the same time, we have the disruption of AI.
I'm not concerned at all. The trend of the market is up. And I think as long as the trend's up, you continue to trade this thing to the long side. Any pullbacks that you get in the market from here forward are a buying opportunity, in our opinion. I think you've got to sort of shut off all this negativity that you hear out there, recession, the Fed, and just trade what actually is happening. What's happening, Frank, is the market's going higher. I think we're in a new bull market. The trend's up. Don't fight the trend. Like you don't fight the Fed, don't fight the...
Damn it. I don't like this, man. I don't like all this bullishness. I felt real comfortable that first half of this year, man. Just being a bull, buying stocks, living life, loving it. and everybody kind of being bearish. I don't like all this positivity, man. Kill all this positivity.
But I think that the Fed is starting to slow down. I think they've done their job.
All right, let's not fight the trend. Let's put this all in perspective. If we look at the historical averages, the S&P likely to rise 4% in the second half of the year. That would put it at about 4670 at year end. Levels we haven't seen since all the way back in January of 2022. That's a pretty big jump. We also have the potential for more Fed hikes. Right now, looking at the CME Fed Watch tool, 86% chance of a quarter-point hike in July, just 3 weeks from now. How does that influence your theory that we're in a new bull market and the stocks have a lot more upside?
Well, like I said, another thing too, Frank. Think about this: you've had a great first half of the year. Think of these fund managers and these hedge fund managers that are behind the curve now that maybe didn't participate in this great upswing that we've had.
Hey, that's my point, man. No stealing my point.
So they're going to start to chase it the last half of the year. When you look at these great first halves and you look at these great second halves, the reason the second halves are so great is because you got people trying to chase it now. You got FOMO, fear of missing out. So there's going to be a lot of money coming back in. You've got $5.5 trillion in cash. That's an amazing amount of cash. I don't think I've ever seen that much cash on the sidelines to fuel this thing higher.
So it's just cash on the sidelines. So when you talk about cash on the sidelines, we keep hearing about the market broadening out. Is this cash on the sidelines going into that big tech trade? Are you still confident in that? And I have to ask you again, the possibility of another Fed hike. How does that change that AI mega cap tech trade in your mind?
I don't think that it changes it at all. Right. I think that mega cap AI, is going higher. I think that is the future. I think that there's so much opportunity there, and I think people need to jump on the bandwagon because I think there's a lot of money that's being missed if you're too afraid to get into this market and this nice uptrend and these great stocks that are doing wonderful things.
All right, so you're still on the bandwagon, but you gave us some other picks. I want to start with one of the picks you gave us in the payment space. Why are you so bullish on payments right now when you're saying all the activities in the mega cap tech trade?
Well,
to be honest, I don't think that I've seen this guy on CNBC for at least a year or so now. I honestly don't think he knows anything about the market, stocks, or anything like that. I'll just be straight up. I really don't think he knows anything. Based upon he needs to constantly look at his papers, he's got nothing off the top of his head. Even the way he flows conversation is so unnatural that if you're having two people that are very educated on the market, you watch Melissa Lee, for instance, on Fast Money, you can tell she knows her stuff. She's so, she can just take it here, take it there, take the conversation wherever. And if you're really into the markets in a major way, like Becky Quick, really on top of things. This gentleman, he needs to shuffle his papers around and so robotic, man. He's trying to get better, but I'll just be honest, I don't know if he pays attention to the market enough to really be able to speak on that sort of level, but yeah, man.
Like you just mentioned ago, it is starting to broaden out. But what I like Visa, one of the reasons I do like Visa is because it is breaking out to a new 52-week high. I love 52-week highs. The way stocks doubles is they've got to make a 52-week high the whole way up to double your money. But they just had a couple of acquisitions, which is going to broaden their revenue base. It's going to broaden out their profitability. So and people are spending money. They're swiping the card. It's wonderful.
But Vance, they are spending money, but they're going to run out of money sooner or later. A lot of people are spending, but they're technically spending on credit. I know it's money to a Visa, but it's on credit.
On credit, but look at this. This economy is doing well. Everybody seems to think that this economy is not doing very well. It's doing great. And I don't think we're going to go into a recession. I really don't. I think that Fed Chair Powell is going to actually sidestep this whole thing. I think that he's raised rates as high as he needs to raise them. I don't think he needs to do another point or two. I think that the markets or the inflation is starting to control itself. I'm bullish. I'm bullish.
All right. So according to our notes, you're 95% invested in the market right now. That means only 5% bonds. You're going to stay that way the rest of the year?
Well, no, we're more than 95 now. We're close to 99. We're just about all the way in. The way we're trading our money now, Frank, is we're buying on pullbacks, we're buying on breakouts, we're rotating our money to different asset classes that we think are going to outperform. Again, AI is our top holding, mega cap growth is our top holding, but there's so much opportunity. I encourage people, get off the sideline and take advantage of this wonderful new bull market.
So, as somebody that generally always leans bullish myself, right? That guy was way too bullish. Hey, slow it down, man. Slow it down. Holy smokes. 99% invested. You need to get in this market. That was a little too much for me, okay? Look at the market in a practical way. You see some great deals out there. You take advantage of those deals. But, yeah, he was a little too FOMO-y for my liking. And that's the thing that kind of worries me a little bit about the market in the second half of the year. I do believe there's going to be a lot of fund managers that have to chase this market, certainly, toward the very end of the year. But, yeah, I'm a little concerned in the that in between time, just for the mere fact that I'm looking at some of these guys, I'm like, holy smokes, man, their time is so FOMO-y now at this point. It's insane. Okay, appreciate everybody joining me as always, folks. Once again, make sure you get in that Patreon tier. That's gonna be pinned comment down there. It closed at exactly 8 p.m. tonight, and we probably won't open that up for a long time. Maybe I'll open up for Black Friday at the end of November for the day, if I even open it up then. So anyways, much love as always. Appreciate you joining me, and have a great day.